10. Assessing the client's situation. The chapter Application and Underwriting described how a life insurance company assesses the life insured, and the applicant, if different, to determine the probability of having to pay out a death claim while the policy is in force, and to determine the appropriate premiums for that policy. This chapter and the chapter recommending an insurance policy cover the general approach that a life agent should take when assessing new clients, in order to determine the best type and amount of life insurance for their situation. This chapter provides an overview of the issues or needs that should be considered, while the chapter recommending an insurance policy describes how to quantify those needs in an insurance needs analysis. The concepts will be illustrated in both chapters using a case study focused on Derek and Becky's family, introduced below. Derek and Becky's family. Case study. Derek and Becky are 47 and 38 years old respectively, and they have been married for 2 years. Derek and his previous wife, Susan, age 44, divorced 4 years ago, and they share joint custody of a son, Jordan, age 8. Prior to marrying Derek, Becky was a single mother to Anya, age 4. Derek formally adopted Anya when they got married. Derek and Becky have just had a child together. Robbie is 2 months old. Derek and Becky are concerned about securing their financial future in the event that Derek dies, and they have approached a licensed life insurance agent to help them assess their insurance needs. 10.1 Assess the family dynamics. Many people use life insurance to provide financial support for their families upon their death. Agents need to understand their client's family dynamics before being able to advise how to best provide that support. 10.1.1 Current spouse. If the life insured is married, or in a common law relationship, he will often want his spouse to receive some type of financial assistance upon his death. The amount and frequency of that support may depend on the nature of their relationship and the surviving spouse's own financial capacity, as discussed below. 10.1.1.1 Dependent versus self-sufficient. In single-income households, the spouse of the life insured may be financially supported entirely by his earned income. In this case, the death of the life insured and the resulting loss of income would be devastating to the surviving spouse. If the surviving spouse has never worked and has no training, her prospects for earning her own income may be limited, and she may need financial support until government benefits such as OAS and CPP begin. If she is the caregiver for the family's children, her return to work would also result in additional child care expenses. In dual-income households, the spouse of the life insured may earn enough income to be partially or fully self-sufficient if the life insured dies. Case study. Derek is employed full-time as the Vice President of Industrial Design for a manufacturing company, with take-home pay, i.e., income after taxes and deductions, of $8,400 per month. Becky currently stays home caring for Jordan, Anya, and Robbie, but she intends to return to work as a human resources manager once Robbie is in school full-time, about 6 years from now. She anticipates that her take-home pay will be around $4,500 per month. However, Derek feels that, if he dies, he would prefer that Becky would not have to return to work until Robbie is 18, if at all possible. If Derek were to die today, the family would obviously suffer from the loss of his income, and, even if Becky could return to work immediately upon his death, her income would be insufficient to maintain the family's current standard of living. 10.1.2 Support obligations to ex-spouse, S. If the life insured has an ex-spouse, he may have a legal or moral obligation to provide financial support to that spouse. 10.1.2.1 Court-ordered insurance. Court-ordered spousal support may stipulate that the support obligation continues even upon death. If the court order is silent on how this support is to be funded, the ex-spouse may have a claim against the deceased spouse's estate. However, sometimes the court order will state that the supporting spouse must obtain sufficient life insurance to cover the support obligation, naming the ex-spouse as the beneficiary. Case study. While their support agreement was not court-ordered, Derek told his life agent that he wants to ensure that the $500 in spousal support is paid monthly to Susan even if he dies. 10.1.3 Minor children. If the life insured has minor children who are financially dependent on him, he will want them to be well cared for if he dies. Usually this means ensuring that they will be able to maintain the same standard of living until they reach adulthood. Some parents may feel this means providing financial support until age 18, while others want that support to be continued through any post-secondary education. Case study: Derek wants to ensure that Becky has the financial resources she will need to raise their children if he dies prematurely. In addition to their living expenses, he would also like to ensure that all 3 children will have enough money to pay for post-secondary education. 10.1.3.1 Current care arrangements. For single-income families, the insurance needs analysis should consider more than the loss of income that would result from the death of the working spouse. The death of a stay-at-home parent can also have a huge financial impact on the family, particularly when the children are young enough to require full-time care. 10.1.3.2 Child support to ex-spouse. If the life insured has 1 or more children from a prior relationship and his ex-spouse has full or partial custody, in most cases he will have a legal obligation to provide financial support for those children. 10.1.3.3 Court-ordered insurance. If the life insured has been ordered to pay child support as part of a court-ordered divorce or separation settlement, in many cases that same court order will require him to obtain sufficient life insurance to ensure that this child support can continue even if he dies. If the court order is silent on the matter, the surviving spouse may still have a claim against his estate on behalf of the children. Case study: As part of their mediated divorce agreement, Derek agreed to pay child support to Susan for Jordan, in the amount of $1,000 per month, until Jordan is 19 years old. While it was not specifically addressed in their agreement, Derek wants to ensure that Jordan continues to benefit from this support even if he dies. 10.1.4 Other dependents. Depending on the life insured's unique situation, he may be providing support to other family members who would suffer financially if he dies. 10.1.4.1 Disabled family members. If the life insured's family includes someone who is disabled and who will need care until the end of his life, it can present an enormous financial burden on the family and have a significant impact on estate planning needs. 10.1.4.2 Aging parents. As Canada's population continues to age, an increasing number of adult children are caring for their elderly parents. Depending on the parent's own financial situation, this care could be both physical and/or financial. If the life insured has assumed financial responsibility for parental care, this should be considered when doing the insurance needs analysis. 10.2 Assess the employment situation. Loss of income is often one of the biggest financial risks associated with death, so the life agent should gain a clear understanding of this income stream, whether the life insured is an employee, a business owner or retired. 10.2.1 Employee. There are a number of different factors that should be considered if the life insured and/or his spouse earn income as an employee. 10.2.1.1 Current income. The first consideration is, of course, the amount of income the life insured earns on a regular basis. A life insurance needs analysis is normally based on the take-home pay, or the amount that the life insured receives after all deductions, i.e., income tax, CPP and EI contributions, union dues, from now until normal retirement age. This represents the amount of spending power that the surviving family will lose if the life insured dies. The income of the surviving spouse is also important, because it represents a source of funds that can likely continue after the death of the life insured. 10.2.1.2 Future income potential. If the objective of the life insured is to allow his family to maintain the same standard of living they could expect to enjoy if he lives into the future, the insurance needs analysis should also take into account his expected future income, including increases for inflation if appropriate. Case study: Derek is a vice president with take-home pay, i.e., pay after all tax and other deductions, of $8,400 per month. He expects to be promoted to Chief Operating Officer, COO, within the next 2 years, which would increase his take-home pay to $9,500 per month, with the potential for larger bonuses as well. This might suggest that he would want the flexibility to increase his insurance coverage in the future. 10.2.1.3 Job stability. The insurance needs analysis should consider the job stability of both the life insured and his spouse. If the life insured's job is at risk, this may mean that he could have trouble paying life insurance premiums in the future, and he might benefit from an insurance product that allows him to decrease premiums for a period of time, without reducing coverage. If the spouse's job is at risk, it may mean that the life insured should plan for greater financial dependency when completing the life insurance needs analysis. Case study: while Becky plans to return to work once Robbie is in school full-time, she is worried that her time away from the workforce and her outdated technology skills may make finding a new job difficult. She may even have to spend time updating her training before she is employable. This makes the replacement of Derek's employment income even more important if he dies. 10.2.1.4 Group Benefits. The loss of employment income may not be the only financial loss resulting from the death of an income earner. Group benefits, such as medical, dental, and life insurance benefits, will cease when the employee dies. If the group benefits include life insurance, the resulting death benefit should be factored in the life insurance needs analysis, as discussed in the section Assess Existing Life Insurance. 10.2.2 Business Owner. If the life insured runs a business, such that he is self-employed, the life agent will need to gain a better understanding of how that business is structured, because it may impact the amount and type of life insurance required. The chapter Business Life Insurance discussed the basic business types, sole proprietorships, partnerships, and corporations, including the flow of income to the business owner, and the taxation of the business interest upon disposition, including the deemed disposition at death, but they are reviewed briefly in this section. Case study: while neither Derek nor Becky is self-employed, Derek has 3 siblings, Peter, Mark, and Kimberly, who all own their own businesses. The examples in this section will focus on their businesses. 10.2.2.1 Sole proprietorship. If the life insured is a sole proprietor, he has to report the net income of the business on his personal tax return. In most cases, if a sole proprietor dies, the business ceases to exist. The deemed disposition rules that apply upon death apply to the assets of the sole proprietorship, not the business itself. Case study: Derek's brother Peter offers strategic management consulting services as a sole proprietor. His business income fluctuates from year to year, but on average he receives consulting income of $120,000 and he has related business expenses of $15,000 per year. He reports the net business income of $105,000 on his personal tax return. If Peter dies, his family will no longer benefit from this self-employment income. Life Insurance Chapter 10, Assessing the Client's Situation 202. His business-related assets are minimal and include some home office furniture and computer technology, all of which have depreciated in value since purchase. If Peter dies, he will be deemed to have disposed of all of his business assets for their fair market value prior to death. Because they have decreased in value, this will not result in a capital gain. 10.2.2.2 Corporation. If the life insured owns a private corporation, he may receive employment income if he is actively involved in the business, and this is recorded as an expense for the business. He may also receive taxable dividends, which are paid with the corporation's after-tax profits. If the life insured dies, he is deemed to have disposed of his shares in the business for their fair market value, which could potentially trigger a large capital gain upon death. If the company is a qualified small business corporation, QSBC, some or all of that gain may be sheltered by the Lifetime Capital Gains Exemption, LCGE, of up to $892,218 in 2021. The LCGE is indexed annually to inflation. However, unlike a sole proprietorship, the corporation can continue beyond his death. As long as the business remains viable without his participation, dividends could still be paid to the beneficiary of his business shares. Case study: Derek's sister, Kimberly, is one of 2 equal shareholders in InterSavvy Incorporated, a successful internet research company structured as a Canadian-controlled private corporation, CCPC. She receives an annual salary of $180,000 per year, as well as dividend income averaging $50,000 per year. The company has 12 other employees, and Kimberly is confident that the business will survive even if she dies. However, she is worried about the tax implications of the deemed disposition of her corporate shares upon her death. Even after using the LCGE of $892,218, she expects that the unsheltered taxable capital gain upon death will be in the order of $500,000. She is also worried about how her family will manage if she dies and they can no longer benefit from her annual salary of $180,000. 10.2.2.3 Partnership. If the life insured owns an interest in a partnership, he will have to report his share of partnership income on his personal tax return. If he dies, he is deemed to have disposed of his partnership interest for its fair market value, which could potentially trigger a large capital gain upon death. 10.2.2.4 Existing buy-sell agreement. If the life insured is one of the owners of a partnership or a corporation, what happens to his business interest upon death may be governed by a buy-sell agreement. As discussed in the chapter Business Life Insurance, if a buy-sell agreement is in place, the owner cannot choose to leave his business interest to someone in his will, such as a spouse or children. Buy-sell agreements typically specify that either the corporation, in a share redemption plan, or the other shareholders or partners, in a cross-purchase agreement, will buy an owner's business interest if he dies. This purchase is done either at a fixed price, or at a price determined by a formula specified in the agreement. An accountant is usually retained to determine the appropriate values. Case study: Derek's sister, Kimberly, and Janet, who is the co-owner of InterSavvy Incorporated, are in the process of implementing a buy-sell agreement. This agreement specifies that if Janet dies, Kimberly will buy Janet's shares from her estate for $2 million, and vice versa. In accordance with their agreement, Kimberly must acquire a $2 million life insurance policy on Janet's life to ensure she has the funds to comply with the agreement if Janet dies. 10.2.2.5 Business income stability and amounts. Similar to the stability of employment income discussed earlier in the section Employee, the insurance needs analysis should consider the stability of the business income, and the business itself. If the life insured is a business owner and his income from the business fluctuates from year to year, or is at risk because of potential failure of the business, this may mean that he could have trouble paying life insurance premiums in the future, or could benefit from a life insurance product with flexible premiums. If the spouse of the insured owns a business with fluctuating revenues, this must be taken into account when assessing the family's life insurance needs, to ensure there is enough income if the spouse dies. If the objective of the insurance needs analysis is to replace the business owner's income, remember that this usually refers to the after-tax or take-home pay, after all deductions, because this represents the loss of spending power that would result from the business owner's death. If the objective of the life insured is to allow his family to maintain the same standard of living they expect to enjoy if he lives into the future, the insurance needs analysis should also take into account any expected increases in income earned via the business. 10.2.3 Retirement. Retirement does not mean that the need for life insurance ends, however, the need to replace employment income may end. 10.2.3.1 Time to retirement. If the life insured is still actively working, the life agent should determine when he expects to retire. This is particularly important if the life insured wants to replace his income until retirement if he dies. Case study: Derek plans to retire at age 65, and he would like to ensure that he has enough life insurance to replace his income for the next 18 years, if he dies prematurely. 10.2.3.2 Retirement income sources. There are several potential sources of retirement income that should be considered during a life insurance needs analysis, particularly if the life insured is nearing or at retirement. If the life insured is a member of a defined benefit pension plan, DBPP, the life agent should determine the survivor benefits provided by that plan. Pension legislation generally requires that the pension plan must provide a 60% to 66%, varies by province, survivor's pension to the surviving spouse. If the life insured used money from a defined contribution pension plan, DCPP, to buy a life annuity, survivor's benefits may or may not be payable, depending on the type of annuity purchased. If the life insured is entitled to CPP or OAS pension benefits, his surviving spouse may be eligible for ongoing survivor's benefits upon his death. Also, if the life insured spouse is entitled to her own employer pension, or her own CPP or OAS benefits, this may reduce her dependency needs if the life insured dies. CPP and OAS benefits payable upon death are covered in more detail in the section Government Benefits. 10.3 Assess current financial situation. The life agent needs to get a clear picture of the life insured's existing financial situation to determine black small square assets that are already available to address his estate needs, black small square debts that may need to be paid upon his death, black small square the amount of income the household currently receives, and how this is likely to change upon his death, black small square how much of that income is spent to meet current needs or is directed towards savings, black small square how much cash flow is available for insurance premiums. 10.3.1 Assets. A life insurance needs analysis should consider all property owned by the life insured that could, black small square, be used to address his estate objectives, black small square have a corresponding liability, example a mortgage, that must be paid by his estate, black small square result in a tax liability for his estate as a result of the deemed disposition upon death. A distinction should be made between those assets the family would be willing to sell to meet estate needs, example, investment assets, and those they would prefer to keep intact, example, the family cottage or beloved family heirlooms. It is also important to record the adjusted cost base, ACB, where applicable, and the designated beneficiary, to determine if a taxable capital gain could arise upon death. 10.3.1.1 Liquid assets. Liquid assets include any items that are easy to sell or convert into cash without any loss in value. Examples include cash, checking account balances, money market funds, term deposits with a maturity of less than 1 year, or cashable guaranteed investment certificates. Liquid assets are useful because they can be used to, black small square, replace the income of the deceased and maintain cash flow until the estate is settled, black small square, pay for final expenses, example, funeral or burial costs, black small square, pay taxes owing upon death, black small square, pay off debts that become due upon death. Without sufficient liquid assets, the executor of the estate may be forced to sell other estate assets to meet these expenses, including property the deceased had meant to go to certain beneficiaries. Furthermore, it may force the executor to sell these assets at an inopportune time, such as when markets are down, or at a price lower than true value, just to complete the sale quickly, i.e., at fire sale prices. 10.3.1.2 Fixed assets. Fixed assets include tangible property that could be sold to generate cash. This includes real estate, example, homes, vacation properties, jewelry or antiques, vehicles or other valuable property. Case study: Derek and Becky jointly own a house valued at $550,000, ACB of $425,000. Derek has a new car worth $45,000, while Becky's used family van is worth $10,000. Derek also owns a cottage valued at $600,000, ACB of $250,000, that he inherited from his father, which he hopes to pass on to Jordan, Anya, and Robbie someday. He also owns 3 vintage cars that could easily be sold for a total of $72,000, ACB $60,000, which he suspects Becky would sell upon his death. 10.3.1.3 Investment assets. Investment assets are those that are used to generate and store wealth for future use, including black small square, shares in public or private corporations, black small square, debt instruments, i.e., bonds, issued by corporations or governments, black small square, term deposits with a maturity of 1 year or more, black small square, pooled investments such as mutual funds, exchange-traded funds, ETFs, and segregated funds, black small square, real estate held to generate rental income, and black small square, partnership or corporate business interests. Again, it is important to record the ACB and the fair market value, FMV, of investment assets, as well as the intended beneficiary, because the deemed disposition upon death could result in a significant tax liability if a rollover does not apply. A distinction should also be made between unregistered and registered assets, example, those assets held in a registered retirement savings plan, RRSP, or a registered retirement income fund, RRIF, or their locked-in equivalents. While registered funds can roll over to a spouse, or sometimes to a child, if a rollover cannot be used, the full amount must be included in the deceased's income on his final tax return for the year of death. Case study: Derek has a non-registered investment portfolio in a diverse mix of equities. The portfolio has a FMV of $280,000 and an ACB of $162,000. It generates after-tax income of $7,200 annually. He has $89,000 in his personal self-directed RRSP, and he has been contributing to a spousal RRSP for Becky. There is $36,000 in the spousal RRSP, and Becky has her own RRSP worth $24,000. They only contribute to the RRSPs in years Derek earns a bonus. 10.3.1.4 Pension Entitlements. If the life insured or his spouse is a member of an employer-sponsored registered pension plan, the life insurance needs analysis should factor in his current entitlement under that plan, as well as the plan's provisions for survivors' benefits, both before and after retirement. Case study: Derek is a member of his employer's DCPP. To date, his account is worth $180,000, including his contributions, those of his employer, and accumulated investment income. Becky is the designated beneficiary of this account. If Derek dies before retirement, the funds will roll over into a locked-in retirement account, which Becky can access upon reaching age 55. 10.3.1.5 Case Study Summary of Assets. The Chapter 11 recommending an insurance policy will be using the information collected thus far about Derek's and Becky's assets, summarized in Table 10.1. Assets: Derek Becky joint liquid assets 10.3.2 Debts. A life insurance needs analysis must consider the family's debts as well as their assets, because the payments can limit the cash flow available to fund estate objectives, and because creditors may demand payment upon the borrower's death. If insufficient cash is available, estate assets may have to be liquidated to satisfy the creditor's claims. 10.3.2.1 Mortgage. Many people who own a house have an outstanding mortgage. If the life insured is the sole owner and mortgagee, this mortgage will have to be discharged before the property can be passed on to its intended beneficiary. If the life insured and his spouse are co-owners and mortgagees, the lender may or may not be willing to extend that mortgage to the surviving spouse alone. In many cases, the life insured will specify that he would like to have sufficient life insurance to pay off this debt, to ease the financial demands on his surviving family. Case study: Derek and Becky have a mortgage of $309,912 on their house, resulting in payments of $1,800 monthly over the remaining 18-year amortization period. Given Becky's current lack of income, Derek would like the mortgage to be paid off if he dies. 10.3.2.2 Credit cards and lines of credit. If both spouses share the same credit card account and one spouse dies, the lender may allow the account to remain open, but it may adjust the spending limit on the card to reflect the surviving spouse's income. Credit card debt can be very expensive because of the interest rates, so ideally it should be paid off as soon as possible upon death. Similar to credit card debt, the lender may allow a line of credit, LOC, held jointly to remain open after the death of one spouse, if the line of credit is secured by assets that remain in the hands of the surviving spouse, example, a home equity line of credit. However, if the property securing the LOC is bequeathed to someone other than the surviving spouse, any balance on the line of credit will first have to be paid off. Case study: Derek and Becky do not have a line of credit and, while they sometimes charge as much as $3,000 to their credit cards in 1 month, they usually pay the balance in full to avoid interest charges. 10.3.2.3 Other loans. Other major asset purchases, such as a car or a motorhome, may be financed with a financial institution or dealer loan, and these loans generally become payable upon the death of the borrower. Life Insurance Chapter 10, Assessing the Client's Situation 210. Case study: Derek has a car loan with a balance of $41,000, with payments of $620 monthly for the next 72 months. He would like this loan to be paid off if he dies. The life insured may also have an outstanding demand loan, which is a loan that allows the lender to demand repayment at any time. Demand loans typically have no predetermined repayment schedule and often only require the borrower to make interest payments. The borrower is also free to repay the loan in full at any time, without penalty for early repayment. Demand loans are often used by investors to leverage their investments. 10.3.2.4 Case Study Summary of Liabilities. The Chapter 11 recommending an insurance policy will be using the information collected thus far about Derek's and Becky's liabilities, summarized in Table 10.2. About Derek's and Becky's liabilities, summarized in Table 10.2. Table 10.2, Summary of debts of Derek and Becky's family. 10.3.3 Tax liability upon death. The insurance needs analysis should also recognize the potential tax liability that can arise upon death. This may result from the deemed disposition of capital assets or the deregistration of registered plans. Derek has a number of assets that have the potential to result in a tax liability upon death, depending on who the designated beneficiary is. Any non-registered property transferred to Becky can roll over, without triggering a taxable capital gain. Similarly, registered plans such as Derek's TFSA, RRSPs, and pension entitlement can transfer into registered plans for Becky if he designates her as the beneficiary. Perhaps the biggest concern is the family cottage that he wants to pass on to the children. If he leaves the cottage to the children, either directly or through a trust, it could trigger a taxable capital gain of $175,000 based on its current value, calculated as FMV of $600,000, ACB of $250,000, times capital gains inclusion rate of 50%. If Becky decides to sell Derek's vintage car collection, this would also result in a taxable capital gain. 10.3.4 Current expenses. The life insurance needs analysis should consider the family's current expenses, including amounts paid for shelter, transportation, child care, food and clothing, allocations to savings, and discretionary expenses such as vacations, entertainment or dining out. Some thought should also be given to how those expenses would change if the life insured dies. Case study: a summary of Derek's and Becky's average monthly expenses is provided in the table below. Cash flow is the difference between net income coming in, i.e., income after taxes and deductions, and cash going out, i.e., expenses and savings commitments. A positive cash flow means that the family can afford to increase expenses, example, buying life insurance, and/or they can direct more towards saving for retirement, education, or other goals. A negative cash flow will result in increasing debt, and it means that the family will have to either increase income or decrease spending if they want to buy insurance. 10.4 Assess existing insurance. The next part of an insurance needs analysis requires the life agent to identify and assess any existing insurance in place. 10.4.1 Individual insurance. If the life insured already has one or more individual insurance policies in place, the life agent should note the following. 35. Black small square type of policy: is it term 100, participating whole life, non-participating whole life or universal life? Black small square face amount / death benefit: what is the original face amount of the policy? For term policies, is the death benefit level increasing or decreasing? For participating whole life policies, are dividends used for paid up additions? For UL policies, is the death benefit level increased by the cash account value or cumulative premiums, or indexed? Black small square cash surrender value, CSV for UL and whole life policies: what is the policy's current CSV and adjusted cost basis, ACB? Will surrender charges apply? How do the current values compare to the initial policy illustration? Black small square policyholder: who owns the policy and can make decisions regarding it? Is it owned by an individual or a corporation or partnership? Black small square life / lives insured: is the life insured the same person as the policyholder? If there is more than one life insured, is it a joint first to die or joint last to die policy? Black small square term of coverage: if it is a term life insurance policy, what is the term of coverage, example, 5-year, 10-year, 20-year? Black small square renewability and convertibility: if it is a term life insurance policy, is the coverage renewable upon expiry of the term? Can the policy be converted to whole life or universal? Until what age can the policy be renewed or converted? Black small square beneficiaries: who is the beneficiary of the policy? Is the beneficiary designation revocable or irrevocable? If the policy names multiple beneficiaries, does it state how the death benefit is to be split between them? If the beneficiary is a minor child, Does it specify what should be done with the death benefit until the child reaches the age of majority? Is the beneficiary a testamentary trust? 34. Black small square riders and supplementary benefits. What riders and supplementary benefits are included with the policy? For example, does the policy include a guaranteed insurability benefit, GIB, rider, which would allow the life insured to increase coverage in the future without providing proof of insurability? For whole life and UL policies, does the policy include a provision for paid-up additions, PUA? What are the coverage limits under the GIB or PUA riders? Does the policy include dependent or family life insurance benefits and, if so, for what amount and who are the beneficiaries? Black small square premiums. What are the premiums currently payable for the policy? For renewable term policies, what are the premiums upon renewal? For UL policies, what are the minimum and maximum deposits? Are the premiums payable for life or for a limited number of years? Are the mortality deductions based on yearly renewable term, YRT, rates or level cost of insurance, LCOI? Black small square limitations or exclusions. Does the policy exclude coverage for death resulting from certain causes or activities? Examples include death while traveling in a specific country, or death incurred while deep-sea diving. An accidental death policy may not cover death that results from illness or natural causes. Life Insurance Chapter 10, Assessing the Client's Situation 215. Case Study. When Jordan was born, Derek, who was 39 at the time, bought a 10-year term policy with a $250,000 level death benefit. Originally the policy named Susan as the beneficiary, but when they divorced he made his estate the beneficiary. The policy has a double indemnity rider for accidental death and is renewable and convertible to age 70. It does not include any other riders. His current premiums are based on standard health rates and are $250 per year. The policy is due to renew in 2 years. The annual renewal rates at age 49, 59, and 69 are $1,125, $2,625 and $6,875 respectively. 10.4.2 Business Insurance. If the life insured is a business owner or a key person in a business, his life may already be insured in connection with that business. However, that does not necessarily mean that the funds will be available to his family if he dies. 10.4.2.1 Relationship to buy-sell agreement. Life insurance is often used to fund a buy-sell agreement, as discussed in the Chapter 8 Business Life Insurance. In fact, the agreement often specifies that insurance must be purchased on each of the parties to ensure that money is available to fulfill the purchase obligations specified by the agreement. Depending on the nature of the agreement, the insurance may be purchased by the individual shareholders or partners, or by the business itself. 10.4.2.2 Type of policy. Is the policy a term policy, whole life policy or universal life policy? If the policy is being used as collateral for a business loan, term insurance is normally sufficient. Policies intended to fund a buy-sell agreement may be term policies, to minimize costs, particularly if the insurance is held personally in a crisscross arrangement. However, there may be advantages to using permanent insurance, such as having the cash surrender value available to buy out the interest of a retiring owner, or having coverage that can remain in place for an indefinite period of time. As discussed in the Chapter 8 Business Life Insurance, if the policy is intended to be an additional benefit for a key employee, it is more likely to be some form of permanent insurance, where the employee can benefit from its tax deferral opportunities, discussed further below. 10.4.2.3 Ownership of policy and payment of premiums. Who owns the policy and who pays the premiums? In most cases, life insurance used for business purposes is owned by the business itself. However, in the case of a cross-purchase buy-sell agreement, the business owners may buy insurance on the other owners personally, under a crisscross arrangement. If the life insured is a key employee and he and his employer co-own the policy under a split dollar arrangement, discussed previously in the Chapter 8 Business Life Insurance, it is important to determine which portion of the death benefit belongs to him, the original face amount or the cash value in excess of the face amount. If the business wants to protect itself from the loss of a key employee while also offering him access to a tax-deferred investment vehicle, the business would own the face amount, and the employee would own the cash value. In this case, the business's share of the premiums would be tied to the reasonable costs for comparable term insurance coverage, and the employee would pay the balance of the premiums. 10.4.3 Group Insurance. The life agent should also evaluate any group life insurance that is in place, including any policies where the life insured is the group member or any policies where the life insured is covered as a dependent of the group member, i.e., if he is covered under the family coverage under his spouse's group life insurance plan. 10.4.3.1 Face amount. Below are questions that the agent must ask himself. Black small square. How much coverage does the group plan currently provide? Black small square. Is it tied to salary, or is it a fixed amount? Black small square. Is there an opportunity to increase the coverage amount, and, if so, is there any limit on the time frame for taking advantage of this? Black small square. Is the death benefit increased in the event of accidental death? 10.4.3.2 Policyholder and conditions of membership. It is important to note that the policyholder is not the group plan member, and that the member has limited rights under the policy, beyond naming the beneficiary and deciding whether to buy any optional coverage on himself or his family. The agent must ask himself the following questions. Black small square. If the policyholder is an employer, how stable is that employer? Black small square. If the policyholder is an association, such as a university alumni association, or a professional association, what are the requirements for continued cover? Black small square. What happens if the life insured terminates membership in the group? 10.4.3.3 End date and convertibility. The agent must ask himself the following questions. Black small square. When does coverage under the group policy end? Black small square. Does coverage extend beyond retirement? In general, many group policies give the plan member the option of converting the coverage to individual coverage if the plan is terminated, or if the member leaves the plan or retires. As discussed in the chapter Group Life Insurance, guidelines set forth by the Canadian Life and Health Insurance Association 36, CLHIA, suggest that the following provisions should apply for at least 31 days after a plan member leaves the group. Black small square. On or before reaching age 65. A plan member should be able to convert up to $200,000 of the group life coverage on his own life to individual insurance without providing proof of insurability, and black small square. At a minimum, he should have the option of choosing yearly renewable term or term to age 65. However, these are suggested minimum requirements and are not legal requirements. Point 37. The agent must also be sure of other elements by asking himself the following questions. Black small square. Does the life insured's group coverage provide for greater or lesser conversion amounts? Black small square. What about spousal or dependent coverage under the group plan? Can it also be converted? Black small square. What would the premiums be upon conversion? 10.4.3.4 Vulnerabilities. When reviewing group life coverage with a client, the vulnerabilities associated with that coverage should be noted, such as black small square. The amount of coverage is usually limited. Black small square. The plan member does not have any control over the policy. Black small square. The policyholder may decide to terminate the contract, or switch providers, without consulting with or getting the approval of the group members. Black small square. The plan member generally must maintain membership in the group to maintain coverage at group rates. Black small square. While coverage is usually convertible to an individual insurance policy, the premiums upon conversion are not guaranteed. 10.4.4 Government benefits. While the government benefits upon death are not usually sufficient to address all of an individual's insurance needs, they are still worth noting. 10.4.4.1 Canada Pension Plan, CPP, Survivor Benefits. If a person who has contributed to the Canada Pension Plan dies, CPP survivor benefits may be payable to his estate, surviving spouse, or dependent children, provided that he meets certain eligibility requirements regarding the amount and duration of his contributions. These survivor benefits may include a death benefit, a survivor's pension, and a children's benefit. His estate, surviving spouse, and children, or their guardians, must apply for these benefits. They are not paid automatically. Black small square Death benefit. This is a one-time lump sum benefit of $2,500 payable to his estate or beneficiaries. Black small square Survivor's pension. The amount that his surviving spouse can receive as a CPP survivor's pension depends on whether or not she is also receiving a CPP disability or retirement pension, her age at the time of his death, and his CPP contribution history. The maximum monthly survivor's pension is $650.72 if the surviving spouse is under age 65, and $722.25 if she is 65 or older, 2021 amounts. If the spouse is over 65 and also receives her own CPP retirement pension, the maximum she can receive in combined benefits is the maximum monthly CPP retirement pension of $1,203.75, 2021 amount. Black small square children's benefit. Children of a deceased eligible CPP contributor can receive a flat rate monthly benefit of $257.58, 2021 amount. If both parents die and they were eligible CPP contributors, the child can receive two children's benefits. The child must be under 18 years of age, or between the ages of 18 and 25 and enrolled in school full-time to receive this benefit. Case study: Derek has been making the maximum CPP contributions for about 20 years and meets the eligibility requirements for survivor benefits. 10.4.4.2 Quebec Pension Plan Benefits, QPP. Survivor benefits under the QPP mimic those under the CPP with the following differences. Black small square: the death benefit, which has a maximum of $2,500, is only paid to the extent of funeral expenses incurred with respect to the QPP contributor, i.e., if the services were provided for free, no death benefit will be paid. Black small square: the maximums for survivors under 45 who have dependent children and or who are disabled are different from the maximum CPP survivor's pension, as shown in Table 10.3. One 0.4.4.3 Old Age Security, OAS, Allowance for Surviving Spouse. Canada's Old Age Security, OAS, program provides for an allowance to be paid to a low-income surviving spouse of an OAS pensioner, provided that the surviving spouse is between the ages of 60 and 64. The maximum allowance is $1,388.92 per month, 2020, but it is reduced by $1 for every $2 of other income. Once the recipient reaches the maximum age for receiving the allowance, she will begin receiving her own OAS benefits. 10.4.4.4 Workers' Compensation Benefits. Workers' Compensation, WC, programs protect employees from the financial hardships associated with work-related injuries and occupational diseases. Employers are required to pay premiums into the program, at rates based on their own risk and safety records, in comparison with provincial averages. Each province has their own WC board, and the federal government has a separate WC board for federal employees. WC fatality and dependency benefits are paid if a covered employee dies from a work-related accident or illness. These benefits, paid to the surviving spouse or children, can vary widely from jurisdiction to jurisdiction, but typically include the following types of payments. Black small square: funeral costs, ranging from $4,000 to an unlimited amount. Black small square: an immediate lump sum, ranging from $2,000 to over $100,000. Black small square: monthly pensions for the surviving spouse and or children that range from as little as $400 per month for a child to 85% of the deceased's net earnings for a surviving spouse with children. Some jurisdictions factor in the surviving spouse's earnings, or earning capability, while others do not. While the WC fatality and dependency benefits can appear to be quite generous in some jurisdictions, it is important to remember that these benefits are only payable if death is caused by a work-related accident or illness. Death resulting from an accident outside of work, or from an illness or disease that is not linked to work, will not result in WC benefits for the surviving family. Thus, WC benefits cannot be counted on to satisfy the family's life insurance needs. Point 38. 10.5 Identify clients' priorities in the event of death. So far this chapter has focused mainly on facts and numbers: how old the life insured is, how many children he has, his marital status, the amount of life insurance he already has, how much money he makes, how much his family spends, and so on. The agent must also understand that the qualitative questions are as important. 10.5.1 Family lifestyle. No one likes to think of leaving their family behind, and nothing can replace the presence or love of a father or mother or sibling, but proper planning can ensure that the surviving family can maintain their lifestyle from a financial perspective. The life agent should determine the client's objectives with respect to the following. Black small square: child care. How long will the children need care, and what type of care? Will the surviving spouse have to go back to work right away after the life insured's death, or can she stay home and make caring for the children a priority? If they need additional care, will this occur at a subsidized daycare, or will a live-in nanny be hired? Black small square surviving spouse's dependency. If the surviving spouse has always been a stay-at-home parent and depended on the life insured for financial support, will that financial dependency continue after his death and, if so, will it be until retirement age? Or can it reasonably be expected that the surviving spouse can become self-sufficient over time? Would additional training or education be required, and how would that be financed? Black small square family residence. Does the life insured want the family to be able to continue to live in the same residence after his death? Does he want it to be mortgage-free? If the life insured was the primary person who performed care and maintenance of the home, will the surviving spouse be able to take over these duties after his death, or will additional expenses be incurred? Black small square cottage/vacation home or heirloom properties. Are there certain properties that the life insured wants to pass on to his children intact, without the risk of having to sell that property just to pay the taxes or funeral expenses? Black small square family business. Similarly, does he have a business that he hopes to pass on to his children, and will the income taxes due as a result of the deemed disposition upon death interfere? Case study. Derek wants Becky to be able to carry through with their plans to have her stay at home until Robbie is in school full-time. At that time, he knows she will be ready to return to work, but her earnings will not be enough to maintain their current standard of living. Thus, he would like to ensure that she has enough money to replace his income for the next 6 years, plus enough to supplement her anticipated income to the same level, until retirement at age 60. He also wants all of their debts to be paid off if he dies. Derek wants to fulfill his commitments for spousal and child support for Susan and Jordan and, while he believes Becky would honor his wishes, he would prefer not to have to involve her in these payments after his death. Finally, Derek wants to ensure that the title to his cottage can pass on to his children, by having enough funds in his estate to pay the income tax that would result upon his death. 10.5.2 Final expenses. Funeral arrangements are a very personal choice and the agent needs to verify this with the client. Black small square. What kind of funeral would the life insured like to have? White small square. Small and simple, or large and lavish. White small square. Burial in a mausoleum. White small square. Cremation followed by scattering of ashes. Case study. Derek does not want an extravagant funeral. He believes $20,000 will be more than adequate to cover his final expenses. 10.5.3 Plans for future. Many people want to look beyond maintaining the family's current lifestyle when determining their insurance needs, by planning for events they hope will happen in the future. This might include things such as black small square post-secondary education. With post-secondary education costs continuing to increase at a pace exceeding inflation, many parents include some provision for paying, or helping to pay, for their children's post-secondary education. Black small square. Weddings for children. Some parents feel it is important to ensure their children can have the wedding of their dreams. Black small square. Other family legacies. Some parents want to go beyond providing for their children's post-secondary education, by planning to give them a lump sum, perhaps upon reaching a certain age, that can be used to help buy their first house or start a business. Black small square. Philanthropy. Dependent versus self-sufficient is often stated as an estate planning objective. Some people like to be able to give at death what they could not afford to give during life. Some estate plans also incorporate charitable giving via insurance as a tax planning strategy. Derek and Becky believe it is their job to prepare the children for adulthood by helping them afford a quality post-secondary education, without necessarily covering the entire cost. Beyond that, they have no intention of providing the children with capital for a home or business. They already contribute to and RESP for each child, and as long as he can ensure that his income will be replaced if he dies, Becky can continue to make these contributions. He believes that another $10,000 for each child will be sufficient to cover their educational expenses. If possible, Derek would also like to make a charitable donation of $100,000 to his local hospice if he dies, because this organization recently provided excellent end-of-life care to his father. 10.6 Next steps. This chapter provided a general overview of the issues or needs that should be considered when doing a life insurance needs analysis. The family's case study continues in the next chapter, recommending an insurance policy, which explains how to quantify those needs and recommend an appropriate type and amount of life insurance coverage for a specific client situation. Chapter 11, Recommending an Insurance Policy. Competency components. Black small square assess the client's needs and situation. Black small square implement a recommendation adapted to the client's situation. Competency subcomponents. Black small square articulate the client's needs based on the risks that could affect his financial situation. Black small square propose a recommendation adapted to the client's needs and situation. Important note, for Quebec readership, the calculations must be completed using the Quebec Pension Plan, QPP, benefits and not the Canada Pension Plan, CPP. Life Insurance Chapter 11, Recommending an Insurance Policy 226.